The traditional view of banking is an illusion. You deposit money, they keep it safe in a vault, and you take it out when you need it. Look, that's just a story. It's not reality. In this explainer, we're going completely under the hood. No fluff. We're breaking down the exact mechanisms, the invisible fees, and the financial engineering that actually dictate how banks make money.
Let's start with a hard fact. Banks don't hold your money. They lease it. If you think there are piles of physical cash sitting around with your name on it, there aren't. In fact, the Federal Reserve completely eliminated all cash reserve requirements back in 2020. That balance you see on your screen, it isn't just sitting there. It's out in the world right now, working for the bank.
So what exactly are they doing with it? They're acting as intermediaries. The very second your deposit clears, that capital is rapidly deployed somewhere else. It gets injected into consumer loans, business lines of credit, government bonds. Your single deposit is fragmented and moved at lightning speed.
Let's look at the math behind fractional reserve banking. Assume for a second we have a 10% reserve requirement. An initial deposit of $100 doesn't stay $100. The bank holds $10 and lends out $90. That $90 gets spent, deposited into another bank, and then that bank lends out $81. As this cycle repeats, the banking system expands that initial $100 deposit into a maximum of $1,000 in new money. They are literally multiplying liquidity.
And that brings us to the net interest spread. This is the fundamental gross margin of a bank. Frankly, it's simple arbitrage. Money comes in at low rates, you, the depositor, might earn a 4% annual percentage yield on a savings account. But that same money goes out at high rates. A borrower pays a 10% annual percentage rate on a personal loan. The bank pays you your little cut, and they pocket the remaining 6% as pure profit.
Section 1. The Hidden Fee Machine. Monetizing the movement of money. Visible lending is only half the business model here. Banks also generate massive income simply by monetizing the friction of moving your money around.
Just look at the historical shift. Non-interest income, which is basically just fees, grew from just 13% of bank operating income in 1986 to nearly 47% today. Almost half of the industry's income is now entirely fee-based. This was driven by a massive dismantling of financial regulations in the 1990s, along with the explosive rollout of electronic financial tech. A prime example of this is the interchange fee. Banks skim a percentage off every single card swipe. You buy a coffee, the coffee shop's bank pays a fee to your bank, and the cost varies wildly. Credit cards hit you with higher fees than debit cards. Premium rewards programs and luxury purchases, those trigger even higher fees. And ultimately, those costs don't just vanish into thin air. They're passed right back to businesses as embedded service charges.
Then there's float revenue. This is pure financial efficiency. Float is the hidden profit banks make by weaponizing the time value of money. Whenever you initiate a transfer, there's a transit delay before those funds actually clear. During that brief window, the bank takes your money and parks it into conservative, short-term investments.
Notice the timeline of transactional flow. There's a literal gap between receiving an investment instruction in the morning and executing the actual wire transfer in the afternoon. Now, it might only be a few hours, but across the billions of dollars moving daily, that tiny discrete window generates highly predictable, risk-free revenue. They simply keep the earnings on money while it's in transit.
Section 2. The Debt Factory. Securitization and liquid capital. Now we're going to pivot from retail checking and swipe fees to institutional financial engineering. This is where banks transform illiquid consumer loans into liquid capital through a process called securitization.
This is how banks rapidly clear their balance sheets. Step 1, they originate loans. Think mortgages or auto loans. Step 2, instead of holding those loans for 30 years, they pool thousands of them together into a separate legal entity. This is called a special purpose vehicle, or SPV. Step 3, they slice up that pool and sell it as tradable securities to investors in the capital markets. The bank gets its cash back immediately, so it can turn around and lend it out all over again.
But this dynamic creates a pretty stark trade-off. On one hand, securitization provides massive liquidity and risk transfer for banks, plus diversification for investors. It keeps the credit markets moving. On the other hand, it creates extreme complexity and a massive moral hazard. Because banks know they're just going to sell the loans off to investors anyway, they're heavily incentivized to lower their lending standards. Once it's sold, the default risk simply isn't their problem anymore.
Section 3. The Data Gold Mine. Turning raw demographics into alpha. Let's move to the final, and really the most modern frontier of banking revenue, Your bank is not just a vault anymore. It's a tech entity, turning raw data sets into pure alpha.
And they're doing this out of strict necessity. Net interest margins have shrunk by 12% over the past 5 years alone. Global fintechs raised a staggering $180 billion in 2023. The competition is ruthless right now. Traditional banks have to adapt. And the data shows that institutions prioritizing data monetization actually achieve 1.5 times faster revenue growth.
They execute this through two main models. Indirect monetization uses data internally. By feeding your transactional data into AI models, banks can anticipate risks and reduce fraud losses by up to 40%. That saves massive operational costs. Then there's direct monetization. This is where they package and sell anonymized insights to third parties. One European bank generated $12 million annually just from subscription-based data analytics.
That leads us directly to strategic data partnerships. Banks aggregate exactly where you spend, when you spend, and what you buy. Then they package these insights for insurers, retailers, and tech platforms. In 2023, JP Morgan Chase actually partnered with Airbnb. By handing over anonymized transaction data and regional economic trends, they helped Airbnb refine its dynamic pricing algorithms. The result was a 5% increase in Airbnb's booking revenue. Your bank is effectively operating as a high-level data broker.
To summarize this profound evolution, there's a great quote from a Blue Book report that states, "Data monetization is no longer optional, it is a strategic imperative. The simple, mid-century model of taking deposits and holding loans is dead. It's been completely replaced by a highly leveraged, hyper-efficient fee and data ecosystem."
Your daily financial life is not just a series of payments. The money you deposit, the friction of your transfers, the debt you take on, and the data from every single purchase you make, all of it is immediately harvested. Knowing this, ask yourself, who is really profiting from your next card swipe?